Hello, and thank you to everyone that's joined so far. I'm just going to give it 1 minute to allow people through from the waiting room, and then we'll begin. Okay, great. So it looks like we've got a good number here already. So let's kick things off. Firstly, hello everyone, and welcome to today's webinar. My name's Louisa Gaynor, and I'm a senior client advisor here at Netwealth. And today, as you can see, I've kindly been joined by Jared Lyons, our Chief Economic Strategist, and Ian Barnes, our Chief Investment Officer. And we're going to provide our outlook for 2025. So we'll be considering questions such as what are the economic and market prospects, both domestically and around the world, and what does this mean for our personal finances? And although a lot transpired over the course of last year, a year that was widely known as a super year for elections, with over 3 billion voters in 72 countries, markets as a whole reacted pretty positively to this propensity for change. And we're going to come on to this and our portfolio's performance later on in the session. But now we need to think a little bit about what 2025 may have in store for us. And there are a number of questions that have been on many people's minds. And a lot of you very kindly submitted some of these to us when you registered for today's session. So I'll be speaking with Ian and Jerry and posing these questions to them so we can get their views on the year ahead, both from an economic standpoint and how this may impact the world of investments. And if at any point you'd like to raise anything else throughout the session, please do feel free to submit this question, and I'll do my best to carve out some time at the end to answer these as well. But now, Jerry, it would be great to start with you here, if that's okay. And if I may, to start by jumping across the pond to the US, where President Trump is due to start his second term next week. He's already mentioned that tariffs are the most beautiful word in the dictionary, and this has been talked about a lot, but it would be just one aspect of his presidency. So can we start with just hearing your insights as to what the other key policies we should expect to see will be?
Okay, well, thank you. It's good to be here again, and thank you to everyone for joining. In terms of your question, just before I answer it, I think it's important to stress that compared to the first term, the markets are of the view that President Trump will be better prepared this time and therefore will be able to execute his policies relatively quickly. Also, compared to his first term, the markets have taken the view, and I think they're correct, that while President Trump has put disruptors up for nomination in a whole host of areas, when it comes to economic and financial issues, the people he's nominated are seen as heavyweights and are seen as very market friendly and seen as very credible. Now, when we get into the nitty gritty of the policies, I think there are two distinct areas here. One is the tariffs that you've mentioned, and the other is domestic policy. Maybe we can come to tariffs in a bit more detail in a moment, but I think it's important to stress the domestic policy agenda because that's what the markets are very much focusing on at the moment. President Trump has talked about being business friendly. That implies lower taxes. He's talking about deregulation in a whole host of sectors. And against that backdrop, confidence has really picked up recently and looks like it will actually have some momentum as we move into the new year. The one area that's outside his remit, shall we say, is interest rates and monetary policy in general. And that has driven the markets in the last year and a half. So in some respects, that's been irrespective of the politics. And we've seen some big changes on the interest rate front last year. This time a year ago, the market, hard to believe now, was expecting 6 rate cuts. By July, they'd factored those out. Then the markets again by July and August started to think about aggressive rate cuts. Now, partly because of the high budget deficit, partly because President Trump's policies are seen as being pro-growth, and also partly because the US economy has shown a lot of resilience. The big change recently has been in terms of interest rate expectations, with the market now far more cautious about the extent to which rates will fall. But when it comes to President Trump's policies, the market's very much focusing on the business-friendly, domestically focused policy agenda. And as I mentioned at the beginning, the expectation is that he will execute that quite quickly.
Okay, great. So they can see they're having some corporate confidence there around what's going on with tax legislation in the US. And can I draw you back to the tariffs that I touched on earlier?
Yeah.
What impact will they have on US inflation and global growth?
Yeah, well, tariffs are seen as a negative by economists. Tariffs are effectively a tax on imports, and it's aimed at making imports less attractive for the US consumer. Now, how does that play out in terms of US inflation? Well, if those external producers are the only ones producing those goods, then it inevitably means higher US prices. But what's likely to happen, or indeed what President Trump would like to see, is US producers substitute for those foreign producers, or indeed maybe even the rerouting of some of those imports that come into the States away from those countries that are hit with tariffs to other countries. So the question then is what happens next? If US producers are displacing foreign producers, then they could, of course, just pass the equivalent of tariff on in terms of high prices to maintain their profit margins or boost their profit margins, or they could actually decide to increase their market share by keeping prices down. So, in answer to your question, tariffs alone would likely add to prices, which is what the markets have started to conclude. But how it plays out depends partly on whether there's a rerouting with some producers elsewhere globally substituting for those countries hit by tariffs, or more likely, US producers fill the gap. Then it's up to them how they actually price the goods. The temptation is naturally for them to try and raise their margins as high as possible, in which case prices do pick up. In terms of elsewhere, it depends on so many factors. It depends on how high the tariffs are, how extensive they are, also whether they're implemented immediately or phased in. And in the last few days, we've had some of President Trump's economics team indicating that they will be phased in. I think they're trying to ease market worries. And then it depends on how other countries and indeed firms respond. Now, in President Trump's first term, there were tariffs imposed on China. Then, albeit much lower and targeted, then China responded by implementing what was called a dual circulation policy, effectively aiming for self-sufficiency in the areas hit by tariffs, such as food, technology, and energy. So how other countries respond will be important. Maybe just to conclude, what's fascinating is before 2008, before the global financial crisis, then the big worry globally was that global trade imbalances would lead to a financial crisis. And in 2005 and 6, the International Monetary Fund pulled together the surplus countries, China, Saudi Arabia, Germany, and the big deficit countries led by the States to try and resolve those trade imbalances. What President Trump focused on in his first term, in some respects, was making tariffs linked to trade, and the narrative he then used was about fair trade. What we're now seeing, which is why it's more uncertain, is that his tariff approach, and as you said, he likes the word tariffs, is not just linked to trade issues, but is linked to other strategic, geopolitical, and non-economic issues, which makes it far more uncertain. And in recent weeks and months has added to worries that some of his strategic partners, some of his allies, might too be hit by tariffs, not just those countries with big trade imbalances. So, in answer, tariffs are likely to add to prices in the States. We can't yet quantify it. They will add to challenges globally, and economists outside the States tend to think higher tariffs means slower global trade and slower global growth. But we might well see some rerouting of trade, and we might well see countries respond to being hit by tariffs by boosting their domestic demand through easier monetary or easier fiscal policies. So again, it's very hard to fully quantify.
And am I right in thinking that any kind of changes to tariffs can be implemented by executive order? So Trump could effectively implement these changes once they've been decided on relatively quickly.
Yes. Yeah. And trade more generally brings Congress in. Even though President Trump had a pretty resounding victory on many criteria, we also have seen in recent weeks the reality that the congressional picture is quite tight. And in the Senate, there are independently minded senators. So that differentiation between external and domestic policy might come more and more to the fore.
Mm. So it's quite interesting, based on kind of what we've covered so far in the US, we're saying that within the US, confidence seems to have risen since Trump won the election, but actually outside of the US, concerns have risen. Do you have a view on who you think is right there?
Well, probably both, actually. Um, Certainly, in terms of the US economy, um, confidence has really picked up. I've said on one of these webinars before that often a good way of thinking about countries is the interaction between the fundamentals, policy, and confidence. And confidence is often the most difficult to predict. But what one has seen in the States is really a bounce in confidence, which is pretty important. The fundamentals are mixed in some respects, but far better than the markets anticipated only 3 or 6 months ago. I say mixed because some softening in the labour market, but overall the US economy is pretty resilient. Policy on the fiscal side, goodness, the budget deficit is very high. It was high under President Biden and in President Trump's first term. It remains high, and it's likely to be given another boost, shall we say, in terms of the fiscal stance President Trump takes. So the fundamentals, policy, and confidence in the States combined should give the US economy some solid momentum. Outside, it comes back to all those moving pieces, shall we say. Let's see what the president does. Let's see how tariffs are sort of executed, how wide they are, how high they go. And then let's anticipate how countries respond. So what we're seeing outside the States, I think, is a reflection of uncertainty as much as anything else.
Yeah, absolutely. And then if we just kind of, speaking of policy, but bringing it closer to home here in the UK, it's been quite an interesting time, and certainly in recent weeks, we've seen bond yields in the UK rise sharply. And while they are off their peak, their level is still pretty high.
Hmm.
Can you just explain? We've had a couple of questions in about this. What drove this this kind of market reaction?
Well, I think there were three factors contributing to the rise in UK yields. One was the international environment. Yields had risen very sharply in the US, partly because US growth is solid and the expectation about US interest rates has changed, but the market's no longer convinced that the Fed will cut rates aggressively. And that's pushed US yields higher. Now, that's had some impact on the UK, partly because the UK is heavily intertwined internationally. And of the G7 countries, the seven industrialized countries in the West, Britain and France are the two countries who are most dependent on international finance in terms of funding part of their deficit. So that global backdrop had an impact. But very much so in the UK, it was those other two factors which were domestic. One was inflation and the other was the fiscal stance. The markets became more worried recently about the inflation situation in the UK, and in particular, fearful that there would be a persistence of inflation, which would actually prevent the Bank of England from aggressively easing interest rates. Yields are slightly off their highs, you mentioned, partly because the inflation figures out yesterday in the UK were slightly better than the market expected and have eased some of those worries. But nonetheless, first worry was the factor was the global picture led by the US. Second was domestic and persistence of inflation. And the third was about the fiscal position in the UK, and in particular worries about the UK government's growth strategy. Confidence was hit by the budget. The Chancellor, I would say, didn't really handle things well in the run up to the budget. The budget itself last autumn, by raising employment taxes, also hit business confidence. The positive aspect of that budget in terms of a focus on infrastructure and investment tends to not be sort of mentioned at the moment, partly because the benefits of that take some time to feed through. So we've had that residual effect. And as we've moved into this calendar year, there's been worries about the growth picture and how that will play out in terms of impacting the fiscal stance. So you add those three together, external and the two domestic, persistence of inflation, and worry about the fiscal position and what policy options that means for the Chancellor in the future.
Okay, and so if we just focus on the fiscal implications there, how is the Chancellor going to get markets on her side? Does she need to have taxes rise? I mean, is austerity necessary?
Yeah, basically, it's a combination of actions and words. In terms of words, it's the Chancellor, I think, needs to reaffirm her commitment to the pro-growth strategy to try and get the markets on side with her economic agenda. But specifically, it then comes down to actions on the fiscal front. Now, when one looks at the fiscal front, effectively there are 5 options. Some might say 6 to address it, but let's knock that 6th one out of the court. And the 6th one is inflate the debt away. Sometimes you hear people mentioning that. I don't think that's credible. So I acknowledge it because 1 or 2 people mention it, but really it comes down to 5 options. And let me list them: grow, reform, tax, austerity, borrow. Ideally, you grow the economy, but the OBR, the independent forecaster, was forecasting 2% growth for this year. Growth forecast, I think, will be revised down, so the markets are cautious. And because of the fiscal rules, which are tied to how much headroom there is for the Chancellor, if growth is weaker and interest rates are higher, that reduces her headroom. So the growth picture changes. On reform, the markets are not convinced the Chancellor or the government will be able to reform public services or the public sector quickly enough to improve productivity and improve value for money. So growth and reform, the 2 of those 5 that are ideal, are seen as not delivering immediately, which then comes down to austerity, tax and borrow. Taxes are already very high. A higher tax take is already factored in for this year. Austerity is about curbing public spending. The markets are not convinced that the Chancellor will step in to curb public spending, but the pressure is now building for her to do so. The markets are worried that if she were to raise taxes further, then that would dampen the growth picture. So what the markets are saying, something has to give on tax, austerity or borrow, and at the moment it looks more likely to be increased borrowing and therefore increased yields. The government will have to pay more money to entice international as well as domestic investors. So in terms of her actions, she needs to do something. An emergency budget is talked about. I think that's unlikely, but at the end of March, the OBR comes up with their latest economic forecast. And that will determine not just their guess or their view of growth, but it will determine the headroom the Chancellor has. And in turn, she may then have to subsequently decide to take action either on tax or on spending. But because she's committed to only 1 fiscal event this year, she will try and deter that to the autumn at the next annual budget.
Okay, thank you. And she's had a lot of negative press recently, but there was one positive piece of news, as you've already mentioned, which was yesterday's UK inflation data. It was better than markets expected, but still above the 2% target. What's your outlook for inflation this year and going forwards, really?
Yeah, well, at the beginning of the year, it was noticeable that in the beginning of year surveys of economists, both in the Financial Times and the Times, there was a lot more pessimism about inflation and about the ability of the government or indeed the Bank of England to achieve their 2% inflation target. Inflation is decelerating. The good news yesterday was that service sector inflation was down from 5% in the year to November to 4.4% in the year to December. So service sector inflation has been persistent, but is easing. So inflation should lose, or is also heavily influenced by energy prices as well, let's be frank. But energy should start, inflation should start to decelerate as we move into the next few months. But I think the challenge really for the UK is this. If growth is strong, inflation will be high. If inflation is low, it's because growth has been weak. The ability of the UK to achieve strong growth with low inflation is not clear cut. So therefore, I think the inflation news yesterday was good. The next few months, it might be slightly better than the market expected, but it's still likely that towards the end of this year, inflation will be persistent, maybe above the 2% target, not far above it, but enough there to keep the Bank of England on edge, shall we say.
Okay, and speaking of the Bank of England, what do you think this means for all this outlook will mean for interest rates?
Yeah, well, interest rates, policy rates are now 4.75%. The markets have moved about a lot in terms of their expectations of rates. We've been relatively consistent in our view, and my view is still that interest rates will reach 4% by the autumn. with a quarter point cut likely each quarter. The last time I did a webinar, that was still my view then. And I said then, if they weren't 4%, they'd be more likely to be 3.5 than 4.5. And I would say that's still the case. 4% rates, interest rates falling. Now, at the last meeting, 3 members of the 9-person Monetary Policy Committee voted for a cut. One of those gave a speech yesterday that was very dovish indeed, indicating that the growth and inflation trajectory was likely to be at the softer end of where the bank had projected things. But obviously, they were talking their own book, shall we say, in terms of their position about rates coming down. But I think what one needs to see for the more hawkish members is clear evidence of that persistence of inflation on the service sector side easing. But even so, I still would like to see, in my own personal view, interest rates settle at a higher level. I think 4% is a good guesstimate, but even if it was 3.5, it would still be far higher than it was pre-pandemic. Partly because, just to remind, low inflation led to asset price inflation, led markets to not price properly for risk, led to a misallocation of capital, and also led to the recent surge in inflation we've seen in the last few years. So I think the bank still needs to tread carefully and ease gradually.
Thank you. And then just finally, before I ask Ian to come back into the conversation, Jerry, can you just give your insights on what you think growth rates will be like this year, both in the UK and around the world?
Well, globally, the International Monetary Fund is usually, in my view, the best benchmark to use. Measures of global growth, and it really doesn't matter which one you use as long as you use the same one, don't chop and change. But the IMF's measure is for global growth to be around 3.2% this year, which is consistent with pretty modest global growth. Not a recession, but the world economy is sort of still keeping its head above water, but modest growth. It might be given a boost in the States because of those policies we talked about, but at the same time, that's offset by challenges elsewhere. China, for instance, last year grew around 5%. 5% growth in China is adding an economy the size of Poland, the 21st biggest economy in the world. China might be slower this year, near a 4 to 5% range. In terms of the UK, actually, I'm quoting in the Telegraph today saying the OBR, I wouldn't be surprised if they almost halved their growth forecast when they came out with their new forecast in late March. The backdrop to saying that was that our figure at Netwealth for growth in 2024 and 2025 was exactly in line with what the OBR was saying. And since the October budget, we've had very weak figures in Q3 and in Q4. And going through the rigorous analysis, I came out with a figure near a 1.2% for UK growth this year. The market, in terms of independent forecasters, is saying 1.4. So even if you go from 2 to 1.4 for the OBR, that's a significant slowdown. If they went the way I've gone from 2% to 1.2%, then that's a significant slowdown as well. And it puts the pressure maybe on the Chancellor to resolve those market worries, to try and get yields down, i.e. the markets on side, but it also implies the Bank of England needs to start easing rates, but the ability to do so will very much depend on their projections of inflation. So modest global growth and UK growth this year higher than last year, higher than in France, higher than in Italy, higher than in Germany, but still far lower than the OBR and indeed most people were expecting only a few months ago at the time of the budget.
Perfect. Thank you, Jerry. That has been really interesting, and you provided us with a great deal of insight here as to the economic backdrop that we're currently seeing and what we may expect to see going forwards. So I just want to switch things up now slightly and focus on our outlook for the year from a market and investment perspective. So thank you, Ian, for joining us again. And we've had a lot of questions in around what may transpire in markets over the coming year. But I thought to start us off, it would just be helpful to remind ourselves of the performance of our portfolios, specifically over the course of the 12 months to the end of December last year. And that might provide us a useful indication as to what we saw then and what we may see going forwards. So if you're happy to bear with me for a moment, I'm just going to share my screen so that we can look at this together. So what we're looking at here first is the performance of all 7 of our risk level portfolios since their inception in May 2016 to the end of December last year. And what we can see is we've color coded them. So that's risk level 7 at the top there in the dark blue. And then in the pink, we've got risk level 6. And then they actually drop down sequentially with their risk level. So you've then got 5, 4, 3, 2, 1. And so what that shows us more broadly is that over the fullness of time, our portfolios act as they should, in that risk level 7 has produced the best returns, risk level 6 second to that, and they drop down with risk level. But equally, if we follow that line backwards, we can also see that with that increased risk level and that increased return, you are also taking on a greater level of risk. So the highest risk level portfolio has been significantly more volatile than that grey line at the bottom there, which you see as risk level 1. So that's just quite a useful thing to bear in mind when thinking about our portfolios on a year-on-year basis. And in that table just to the right of the chart, we can see in that third column there, we've got the annualized returns. So that's the average annual return for our portfolios since their inception in May 2016. And we can see again, risk level 7 is at the top there with an average annual return net of fees of 8.2%. And then again, they drop down sequentially with risk level 1 being at the bottom there, returning 1.5% net of fees. And if I just move on to this second slide here, and I appreciate it's quite a busy slide, there are a lot of numbers here, and I just want to focus your attention to the far to right-hand side columns. So the far right-hand side column is, again, looking at the same figures we saw on the previous page, the annualized since inception return. So you've got that 1.5 figure at the top there in risk level 1, and dropping down to the bottom in bold there, you can see that 8.2% figure, which is that risk level 7 annualized since inception return. But interestingly, and just to give us a bit of context as to the performance of our portfolios last year, if we go back a column to that second last column there, we're looking at the 12-month period to the end of December last year. And what we can see at the top there is that risk level 1 over that period returned 4.8%, which is relatively high compared to its annualized since inception return. And really, but that's because it was benefiting from the current or then high interest rate environment. And if we move up the risk spectrum, so if we go down to risk level 7 at the bottom there, we can see that that again also returned higher than the average annual return at 11.7% net of fees. And that's largely thanks to the equity market exposure and was supported as well by our alternative investments. So now that we've had a look at that, I actually just want to think of that and bear that in mind, Ian, when we turn to the first question that has come in from a lot of audience members around what is our expectation for market performance in the coming year?
Well, thank you, Louisa, and it's pretty good timing, as we come into the new year and we think about what lies ahead, to think about the near term. But for us, all of those considerations are really shaped by our longer term forecasts as well. So we know from lots of experience, and indeed your chart there showing the volatility of some of those performance numbers sort of demonstrates that, is that it's very difficult to put numbers on short-term frame performance for any invested assets. I think the really helpful thing, though, as you've suggested and through your conversation with Jerry, was that we're starting from a point of higher cash rates. The zero or very low cash rates over much of the past decade really made investing in different assets quite precarious. So riskier assets tended to benefit from earnings growth, but anything that was focused more on generating a level of interest based off those low rates really found it quite tricky. So on a longer term basis, on about a 10-year time frame, we expect that equity market performance is going to be probably around 7%, which is slightly lower than those gains that have been realized historically. But our expectations for anything oriented more towards fixed income or keying off those slightly higher cash rates, and as Jerry said, we expect cash rates to stay above the levels that we saw in the depths of the past decade. We expect that those returns are going to be a little bit better. So overall, we'd expect returns somewhere in the line of 4 to 7%, depending on the risk level. If we think about how we plan for that environment, bringing it back down to what we're doing today, then we think we have to plan for really quite a wide range of outcomes. The the arrival of Donald Trump is certainly going to cause some waves around the way that different companies trade with each other around the world. And no one really knows what the outcome of that is going to be, where the burden of some of the policies are going to lie, as Jerry was suggesting.
Mm.
But ultimately, we expect reasonable growth within the US, and a strong US economy tends to be pretty good for risk assets. So that's helpful, as long as that doesn't feed into too much inflationary pressure or force interest rates up in a spike, or indeed if the gap with other regions grows too wide. But that's not our base case.
And so you mentioned there about the US and Jerry mentioned as well how they feel pretty confident, and that's been reflected in equities. So do you see US equities leading the pack again this year?
Yeah, well, that's the massive question. I mean, really, the word that everyone has come to use with regards to the US versus the rest of the world is this idea of exceptionalism. So the experience for US equity investors has been very different from that of the investors who are invested, on a more diversified basis internationally, or indeed just away from those mega cap companies that we all are so familiar with. And how that plays out is in the short term is really open to question. The positives around the US is that it is still home to these high quality, strong earnings generating companies. So over the past 15, 20 years, really since the collapse of the last tech boom, we've seen that US equities have generated real earnings growth, so above inflation earnings growth of more than 3%. And that is what has stood them out versus the rest of the world. So in the UK, it's been much more anemic. Japan has had obviously a lot of challenges as well. And Chinese market getting used to a slower growth profile has impacted that market as well. But the question is how long that is going to be sustained for. And in the near term, we definitely see a lot of support for that earnings growth. The question is how far into the future that can be supported. Other positive points are loose fiscal policy that Jerry has mentioned, and a very sort of responsive monetary backdrop as well. And it's broadly, the US is very, very capital friendly. We've had it's had a long tradition now of doing stock buybacks to sort of help boost those earning per share numbers. And also the idea that the sectoral influences in fast growing parts of the economy make up a much bigger part of the market. So those are the positives. Set against that, however, you have to think about what is already baked in. So we know that valuations are pretty rich relative to the rest of the world, but also relative to the market history. We think that by a range of different measures, US equities are probably more expensive than they've been around 90% of the time. And we would expect that situation to normalize a little bit, maybe not immediately, but certainly over time. We don't think it goes all the way back down to long-term average valuations, but probably just takes a bit of the edge off. So that will provide a bit of a ceiling to performance. The other aspects that we need to think about are the increasing narrowness of the market. These really sort of super fast-growing companies just getting bigger and bigger. That tends to indicate a little bit of riskiness entering into the marketplace. But also investor positioning, we think, is a little bit complacent. So so we have to weigh up all of the things that could work in the US favor, but also against it. Overall, we think it's in a pretty good state. But quite a lot of good news is already priced in.
Yeah. And then kind of looking closer to home, what about the UK? You described it a moment ago as a bit anemic. What are your thoughts there about how UK markets may perform?
Yeah, so Jerry touched on some of the macro challenges, and I think we've seen pretty weak economic growth historically. That's also reflected within the equity market in terms of those companies that are domestically facing. Quite a large chunk of the UK market is made up of international companies who earn a lot of their money abroad, quite a lot are in materials and commodity facing industries. So that also has an impact on their earnings capability. We do think that the UK remains attractively priced. Historically, it's traded at around a 20% discount to the US, so that every dollar earned is valued 20% more cheaply by the market on average in the UK versus the US. That figure's increased to about 40% at the moment, so that should be supportive. But really, it's the sector mix that we find most appealing about the UK rather than necessarily the valuation point. So we think the market's cheap, but we think it's facing pretty clear challenges
Yeah.
at this point. And our bias, after reasonable performance in the past period of volatility, our bias is probably going to be to reduce that a little bit in the future.
Okay, and what about any other regional or sector preferences that are noteworthy or maybe so over the course of 2025?
Yeah, so there are lots of opportunities out there, which is really good news. I mean, the big question again just comes back to how US trade policies hit different economies and different market constituents. We know that a lot of focus has been placed by the incoming president on relations with China. Chinese policy is also at a point of change at the moment. We think that we're likely to see a little bit more activity come through from domestic policymakers, and they're going to use that as a bit of a tool in terms of negotiating the outcome in relations with the US. European markets face the same domestic challenges as the UK. There's a lot of political instability, but feeling's been pretty negative around Europe for a while now, and despite some of those concerns growing, it's actually got off to a really strong start this year. So it'll be interesting to see if that retains. One of our favourite parts of the market, though, is within Japan. We think that the fundamentals are improving. We think that valuations are still attractive, and policymakers are attentive to engaging and making change there as well. So there's lots of opportunities for internationally diversified investors.
Great. And what about, you mentioned kind of regional preferences there, but what about asset classes? Would you say bonds still have a role to play within our portfolios?
Yeah, absolutely. So you saw there the challenges that really conservatively positioned portfolios had in terms of generating returns over the past while interest rates were at zero. So what we've seen through this cycle of the pain of inflation driving yields higher is that now your bonds are actually in a reasonably attractive place. Both the UK and the US are yielding above 2% after inflation expectations are taken into account. And that's really impactful if you think about how that could compound over a 5-10 year horizon. We know that interest rates are going to come down. If they do so in a measured way and without a huge growth scare, then we think a diversified portfolio of fixed income is pretty helpful as well. One area we don't particularly like at the moment is corporate bonds. They've really been the beneficiaries from some of the concerns around sovereign issuance. So how governments are going to be able to meet their commitments. Yield-hungry investors have said, well, I can get a secure corporate yield of a pretty attractive level as well. What that's done, however, is just driven down that excess spread of yield above government bonds, and we don't really think that investors there are being as well compensated as they might hope. So it's great if you're a fixed income specialist, but within the context of a multi-asset portfolio, taking on that corporate risk and sort of accepting that fundamentals are good, we think you've got a lot more upside in selective equity markets rather than stepping in on the corporate side. So really, bonds at the moment we see as attractively valued. The difference, however, is that they're not acting as the diversifiers that they've historically acted as in the past. And so that's the reason why 3 years ago, when we're seeing that
Mm.
inflationary spike come through, we broadened out our exposure there to commodities. So gold had a fantastic year last year. Commodities are doing particularly well. They tend to be quite immersed in all of the geopolitical news that's going through as well. But it tend to not only be a cause of, but also sort of feed off inflationary pressure as well. So commodities have got a role for us to play as well in that regard.
Great, thank you, Ian. And now I'm conscious of time, so I'm just going to ask Jerry to come back on screen as well. And I'm going to try and go through some of the questions that have come in during the session. So hopefully Jerry will join us in a moment. But there's been one in, Ian, that hopefully you can help us with. It's asking about our overview of the real estate market in the UK.
Yeah, gosh. Okay, so we don't have any explicit commercial property exposure within portfolios. We have found that property has really been in the worst of both worlds in terms of having some sort of expectation for growth requirements, but also keys off interest rate pressure as well. So it's really seen some volatile periods. I was actually having a conversation with a client this morning who works in that space, and an additional um, headwind that property might face in the future is from the struggles of the DB defined benefit pension sector, which has sort of historically been a real anchor for that asset class. Now, some of the opportunities are broadening out for those types of investors, and we think that that just means that the marginal dollar is just going to be that much harder to find for commercial property, so they're not going to really have much support. So for the time being, even though prospective yields have increased, valuations have fallen. We think there's quite a high hurdle for us to start investing in that area. And if we did, it would definitely just be on a cyclical basis rather than a more permanent investment.
Mm. Okay, and Jerry, anything you want to add to that? Or Ian summarised it perfectly for you.
Yeah, well, I agree with what Ian said. From a macro perspective, often when economists project the housing market, they often are put in the forecast that's in line with earnings growth in the UK. So it's sort of above the rate of inflation. That's usually used as a benchmark. One has to differentiate between what's happened in the top end of the property market recently in the UK and the rest of the market. The top end has been hit, not maybe by valuations, but by some of the recent perceptions about UK policy towards international investors. So there might be some stability of that as we move through the year, but that's just the additional point.
Yeah, no, thank you. And then, Jerry, perhaps you could provide a bit of insight. We've had a couple of questions in around AI,
Okay.
and people asking what the impact of this is going to be during 2025. Is it going to be a disruptor of wealth?
Okay. In terms of AI, the one area where it could be really disruptive is the one that people aren't talking about at the moment, and it's linked to digitalization in terms of global currencies. Last autumn, the Chinese took their mBridge, their digital currency, to a new level. There's 5 central banks involved: the People's Bank of China, Hong Kong Monetary Authority, Bank of Thailand, UAE, and Saudi Arabia. But about 15, 20 central banks, number from the West, closely observing, partly because globally in economic terms, you've gone from globalization to fragmentation. But for that fragmentation to really embed itself, you would need to see fragmentation in the global financial system. So if there's disruption linked to digital, it's the area people aren't talking about. That's on the currency side. Bring it back more to the UK, and to economics more generally. AI's impact is very much on growth and jobs. Now, historically, we have seen many previous periods when there's been new technology, and they've all gone through the same phase. you tend to have the initial disruptive phase where jobs are lost. Then you have an income phase and a creative phase. Income phase as prices, growth picks up, growth prices fall, people have more money to spend. Creative phase, jobs created in areas that didn't previously exist. Think mobile phones 30 years ago. AI might see the speed and scale of that transformation being even quicker. But when it comes to jobs, for instance, beginning of this week, the Prime Minister, Keir Starmer, talked about AI rolling out. Robert Peston asked one of the questions from the floor, what impact is this going to have on jobs in the public sector? Now, the worry is that clearly for AI to have an impact in terms of boosting productivity, it might have an impact on jobs. But maybe the focus is very much how roles will change, particularly in the private sector. You'll be able to use AI in a way to make your own role more effective. So jobs might not necessarily go in totality, but roles will change. In answer to your question, does it have the potential to be disruptive? There's no doubt it will be disruptive. Whether it's disruptive this year or over coming years remains to be seen. But the one area on the digital currency space, because that's linked to the whole technology sphere, that's an area to keep a close eye on, partly because not enough people are talking about it, I would suggest, at the moment.
Perfect. Thank you. Thank you, Jerry. And just one question I quickly want to pick up on as well, because I can see we've had a couple in around tax efficiencies and also pension legislation. This was obviously reviewed and actually some only small changes were made in the October budget. But just to outline that, I think it is worth noting that actually the majority was left unchanged, and so pensions can still be seen as beneficial. Just to remind people, the LTA wasn't reinstated. That's the lifetime allowance. So there is no tax charge on pensions in value that are valued in excess of your LTA. Your 25% tax-free cash entitlement still remains. If your pension is at or above the historic LTA, then you're still entitled to take up to £268,275 of tax-free cash from your pension. So that was something that we were concerned may be removed or capped. It wasn't. And just to remind people as well, because we had a couple of questions in on this, tax relief on contributions still remains. So you can get tax relief of 45, 40 or 20% based on your taxable income. And so it's quite a beneficial way of managing that through the accumulation stage of your life. And also, once the funds are within a pension, it still remains a tax wrapper for investment purposes. So capital growth and income generated are sheltered from income and capital gains tax. So when it comes to thinking about making a contribution, it certainly still is worth it from that aspect. The area that did change was around the rules of inheritance tax. So from April 2027, your pension will be inside the scope of inheritance tax. So that obviously is significantly less advantageous than before. But what we think in the conversations we've been having with clients is how it can still be beneficial to grow your pension whilst you can. And then we just need to adjust our planning in the decumulation phase of our life. So looking at your overall family's position, thinking about gifting earlier or more regularly may make sense. And it's something that we've been discussing quite a lot with clients. So if you do have any more kind of specific questions around that financial planning aspect of the outlook for the year, please do get in touch at advice@netwealth.com and we can talk about that in a little bit more detail. But just before we close, thank you, Jerry and Ian. I very much appreciate your time. And before we started the session, I asked you both to name your key takeaways for 2025. And I'm just going to pull them up on the screen here. But Jerry, if we could start with yours, what would you say your key takeaway for 2025 will be?
Okay. Well, last year, 2024, as we all know, and as you touched on, Louisa, was a year of elections. Maybe we should think of 2025 as the year in which those newly elected or re-elected politicians execute their policies. Most focus globally is on the US, but India will clearly be of interest for many people, as will for us events here in the UK. So globally, it's about President Trump's policies, and we talked about how they're likely to land positively within America and maybe add to uncertainty outside. Here in terms of the UK, it's about how the government can get itself back on the surer footing, having had, let's be quite frank, not the ideal start. And so basically is addressing those fiscal concerns that we touched on earlier. And maybe on the positive, the Bank of England will be able to cut interest rates to 4% by the autumn, easing some of the pressures in the UK. So last year, year of elections, this year, the year in which policy is executed both globally and also domestically.
Perfect. Thank you, Jerry. And Ian, if I may, same question to you, please. What are your key takeaways for 2025?
Yeah, well, as the points show there, we think that it's a pretty good opportunity for investors to receive some above inflation gains on their invested portfolios as rates come down in a measured way. We think that that's going to be pretty supportive. The next point is really about trying to get diversification right. And that's what we spend a lot of time on the desk doing, trying to think about how different asset classes interact with each other, and also the way that different markets are going to respond to a very changing environment. So we'll be making sure we get diversification right and try and capture all of that broadening of market performance, which we think is going to be pretty healthy for investors as a whole. The last point is really, we know that the next 4 years are going to be pretty noisy, and we've got to try and strip out everything that's going on in terms of the media pronouncements and what we see on the news day to day, and really focus on the fundamentals that are going to be driving different asset class performance. Make sure that we're comfortable with all of the different pieces that go towards a nice rounded portfolio.
Perfect. Thank you, Ian. And then I've just included a final point there about reviewing your financial plans. So this really should be done on an ongoing basis. It's always important to understand how you're positioned and whether that still makes sense in the context of any changes to fiscal policy and actually your own wider circumstances and objectives. So we would always advocate for having a robust financial plan in place. Doing so now will make you much more adept at adjusting to the evolving landscape, both economically, as Jerry's highlighted, in markets, as Ian's mentioned, and across tax legislation going forwards and in the future. So if you do want to discuss your plans with a member of the advisory team, please do feel free to email us at advice@netwealth.com. Thank you all so much for your time today. I appreciate all the questions you've submitted before and during the session. We've tried to answer as many of those as possible, but do feel free to email them if you'd like a more direct conversation with one of the advisors or even with Ian and Jerry themselves. So I'm just going to close now as well by thanking Ian and Jerry very much for your time. I very much appreciate it, and I'm sure everyone in the audience has as well. And thank you all, everyone, for attending as well. I appreciate you giving up part of your day. You'll receive a recording of the session shortly afterwards as well. But if you do have any questions, please do get in touch. So thank you very much and goodbye.
Thank you.
Thank you. Bye.